Welcome to our deep dive. Our mission today is to unpack a massive, newly published investigation from the New York Times.
Yeah, and it's a really wild one.
It really is. We're looking into this hidden corner of the financial world. Like, we're going to figure out how everyday slip and fall lawsuits, the kind of personal injury cases you see advertised on highway billboards,
Right. Yeah.
how those have been secretly transformed into high-yield tradable assets for global Wall Street investors.
Yeah, it's a pipeline most people have no idea even exists.
Exactly. And to understand how that pipeline works, we have to start with this one piece of security camera footage. And it looks entirely unremarkable at first. It's just another day on a Manhattan construction site.
Yeah, it shows a worker doing some routine repairs on a church facade, and nothing stands out until the incident actually happens.
Right. So the worker is a man named Danny Anguissaca Morales. And you watch the video, and he climbs a few rungs up a ladder. Then he leans to his left, and he just drops to the scaffolding below. Yeah, and shortly after that fall, he files a multi-million-dollar lawsuit claiming severe injuries, PTSD, and an inability to work.
Right.
But the story we are digging into today isn't actually about whether that specific fall was real or exaggerated or entirely fake.
No, it's about the machinery.
Right. It's about the machinery that kicks into gear the second the lawsuit is filed. So what does this all mean? Like, how does a single moment on a ladder become a financial instrument?
Well, to grasp that transition, we really have to look at the financial plumbing that keeps modern litigation afloat.
Okay.
Because a personal injury claim, it is no longer just a legal dispute between an injured person and an insurance company.
Right.
It has become the raw material for this highly sophisticated, multi-billion-dollar financial machine.
That's just wild. So let's put ourselves in the shoes of someone like Danny, or really anyone who has filed a major personal injury lawsuit. The legal system, as we know, moves incredibly slowly. I mean, these cases can drag on for 3, 4, even 5 years before there is a settlement or a jury verdict.
Oh, yeah, easily.
And during that half-decade, the plaintiff still has to pay rent. Groceries still cost money.
Exactly.
And they likely have medical bills piling up, especially if they're claiming that they cannot work.
Right. So that time gap, the years between the initial injury and the eventual payout,
Yeah.
that creates an enormous liquidity crisis for the plaintiff.
Mm-hmm.
And, wherever there is a liquidity crisis, an industry will inevitably spring up to fill the void.
Naturally.
Yeah. In this case, that industry consists of consumer legal funders.
Okay, so on the surface, the pitch from a consumer legal funder sounds like a lifeline.
It does.
These companies, they float cash advances to plaintiffs. They essentially say, here is the money you need to keep a roof over your head while your lawyers fight the insurance company.
Right.
And the primary selling point is that this cash is completely risk-free for the injured person.
Mm-hmm.
Like, if you take the money and eventually lose your case in court, you do not owe the funder a single dime.
Right. And that mechanism is the fundamental pillar of this entire ecosystem. It's called a non-recourse advance.
Okay.
And it differs completely from a standard bank loan.
Mm.
Because if you take out a personal loan from a bank and fail to pay it back, the bank has recourse to go after your car, your house, or...
Garnish your wages.
Yeah, exactly. Garnish your future wages.
Yeah.
But with a non-recourse legal advance, the funding company's only collateral is the lawsuit itself.
Wow, okay.
Yeah, they only get paid out of the final settlement. If the settlement is zero, their return is zero.
Which sounds great for the plaintiff up front. But, I mean, the funder's taking on the risk of a total loss, and they obviously aren't doing this as a charity.
Oh, absolutely not.
Right. So if the plaintiff wins or settles, the repayment comes with interest rates that average 35 to 45% a year, and that interest compounds.
Yeah.
Is this essentially a high-stakes casino where the funder is acting like the house, placing bets on jury verdicts and just taking a massive cut of the winnings?
Well, what's fascinating here is the regulatory arbitrage taking place. Because, these advances are technically contingent on the outcome of a lawsuit, many states do not classify them as loans.
Oh, because it's an advance.
Right. And because they aren't legally loans, they're often entirely exempt from state usury laws.
Usury laws being the ones that cap interest rates.
Exactly, the laws that cap how much interest a lender can charge. So that loophole allows the funders to apply that 40% compounding rate entirely legally.
And the compounding math is where this turns brutal.
Yeah.
There's a specific detail in the Times investigation about a woman in New York who turned her ankle on a sidewalk.
Oh, this story is rough.
It's unbelievable. So she received $76,500 in advances from a legal funder just to help her survive while the case was pending. But the case dragged on, and by the time it finally settled years later, the math had snowballed so aggressively that she ended up owing her funder at least $1.4 million.
Yeah, you see the mechanics of exponential growth in action there.
$1.4 million off 76 grand.
Right. When a legal battle stretches out for half a decade and you are compounding interest at 40% annually, the balance doubles and then it quadruples.
Yeah.
And that mathematical reality drastically shrinks the actual compensation the injured party eventually receives.
Right.
The plaintiff might win a massive settlement on paper, but after the lawyers take their standard 1/3 contingency fee,
Yeah.
and then the funder takes their principal plus the compounded interest, the injured person is left with just a tiny fraction of the payout.
Looking at those numbers, it brings up a major structural question about the funders themselves. Like, if a local legal funding shop is handing out $75,000 cash advances to hundreds of plaintiffs and then waiting 5 years to see a return,
Right.
they would need a monstrous pool of liquid capital just to survive the wait.
Oh, a massive pool.
Yeah, a local storefront operation doesn't have hundreds of millions of dollars sitting around to float a 5-year waiting period. So where is all that initial cash coming from?
They turn to the secondary market.
Okay.
And this is the exact inflection point where the local slip and fall goes global.
Wow.
The consumer legal funders need constant liquidity to keep making advances. So they package their lawsuit IOUs and they sell them to Wall Street.
Wait, we are talking about the same mechanism used for mortgages, right? Like asset-backed securities.
The underlying financial logic is identical.
That's crazy.
Yeah.
No.
Before the 2008 financial crisis, Wall Street took thousands of individual home mortgages, bundled them into a single massive asset, and sold slices of that asset to investors.
Right.
And today, they do it with auto loans and credit card debt. And the mathematical premise relies on the law of large numbers.
How so?
Well, if you hold one person's auto loan, your risk is heavily concentrated. If they lose their job in default, you lose everything.
Yeah.
But if you pool 10,000 auto loans together, the aggregate behavior becomes statistically predictable.
Okay, I see.
You know, a certain percentage will default, but the vast majority will pay, generating a steady stream of revenue. And Wall Street realized you can apply that exact same pooling mechanism to lawsuit advances.
So a legal funder takes thousands of these non-recourse agreements, the promises that plaintiffs will pay them back plus 40% interest when their cases settle. They put all of them into a metaphorical blender, bundle them up, and sell the aggregate pool as a security to global investors.
Exactly. And that generates immediate fresh capital for the funding companies.
Right.
They take the money, Wall Street just paid them for the bundle, and they use it to immediately go out and fund thousands of new lawsuits.
Which they then bundle and sell again.
Over and over.
The investigation lays out the sheer scale of this, and it's massive. Just 6 major funders account for more than 90% of these advances nationwide.
Wow.
And since 2020 alone, there have been over 24 of these securitization deals. We're talking about hundreds of thousands of individual personal injury cases being bundled up. They have raised $2.8 billion from investors in that time frame. But hold on. If these securities are being sold to institutional investors, who are the actual end buyers? Are these just high-risk hedge funds, or is this making its way into normal mutual funds?
Oh, it is entirely mainstream.
Really?
Yeah. Pension funds, university endowments, and large mutual funds are buying these securities.
No way.
It is highly likely that everyday retirement accounts are holding fractions of these bundles.
Wait, if these are bundled and sold to institutional investors like mutual funds, does that mean everyday Americans' retirement accounts are indirectly funding someone's slip and fall lawsuit?
Yes, absolutely.
That is nuts.
From a portfolio manager's perspective, these lawsuit securities are incredibly attractive. They offer very steady yields, averaging around 7% and sometimes stretching up to 17% depending on the risk tranche.
Wow.
But the most valuable characteristic for an institutional investor is that these returns are uncorrelated assets.
Because an insurance company paying out a settlement for a car crash doesn't care what the Federal Reserve is doing with interest rates that day.
Precisely.
The lawsuit timeline and the final settlement amount operate completely independent of macroeconomic conditions or inflation, or whether the S&P 500 is in a bull or bear market.
Right. Uncorrelated yield is the holy grail for asset managers looking to diversify.
I bet.
But that massive institutional demand for a steady 7% yield, it fundamentally alters the ecosystem on the ground.
How so?
Well, when Wall Street buys into a sector, it demands predictable, high-volume returns. The securitization process requires constant fuel.
Okay, let's unpack this. Because when you introduce a Wall Street yield target into a local legal market, you are essentially speeding up the conveyor belt in a factory.
Right.
The legal funders have to find more raw materials to feed the machine to hit their numbers. And in this specific industry, the raw material is human injury.
Exactly. And the Times investigation highlights how that financial pressure trickles all the way down to the individual plaintiff.
Yeah.
To hit the required volume, the funding companies implement strict sales targets.
Right. There is a former salesman in the reporting named Daniel Listowski, and he worked for a legal funder called U.S. Claims. His individual quota was to issue $500,000 in cash advances every single month.
Every month. That's a lot of advances.
Yeah. He described constantly calling attorneys, essentially cold calling them, asking if any of their clients needed money, and he was eventually fired for failing to generate enough business.
Wow.
But the aggressive sales tactics are just the surface layer, because the demand for volume warps the medical reality of the plaintiffs.
Right. Consider the economic incentive structure here.
Okay.
To justify a large cash advance, which is required to generate the large interest returns that feed the Wall Street securities,
Yeah.
the underlying lawsuit must have a high estimated value.
Right. You can't get a huge advance on a tiny claim.
Exactly. A minor soft tissue injury, like a sprained back, might only settle for $20,000. You cannot advance a lot of money against that.
No.
But a severe injury, one requiring invasive surgery, can push a settlement value into the millions.
And the investigation uncovered numerous allegations of plaintiffs being steered or outright pressured into highly risky, incredibly expensive medical procedures.
Right.
We are talking about cervical spinal fusion.
Good man.
Surgeries that permanently alter the architecture of a person's body.
Yeah.
And the allegations suggest these procedures are sometimes ordered not because they are medically necessary for the patient's recovery, but simply to increase the monetary value of the lawsuit so the financial machine can continue to operate.
Well, the power dynamics make this entirely plausible.
Yeah.
Because the plaintiffs are often low income, they're in severe pain, and they're desperate for the cash advance just to avoid eviction.
Right.
When a lawyer or a medical provider suggests that a surgery will not only fix their pain, but also guarantee a massive payout that allows them to get their advance.
Yeah, it's hard to say no.
The patient is rarely in a position to seek a second unbiased medical opinion.
And the systemic nature of this is laid out in a major whistleblower lawsuit. So Christopher Hassett was a vice president at Cartiga, which is a prominent New York-based legal funder.
Right.
He sued the company, claiming he was fired in retaliation for flagging fraudulent cases. According to his filings, he identified a specific law firm and a runner, which is someone who recruits plaintiffs off the street, who appeared to be systematically manufacturing fake injury claims.
Wow.
Yeah, and Hassett alleges that when he brought this to the CFO of Cartiga, he was told to keep those shady cases on the books specifically because they needed to maintain their funding volume.
Now, it's worth noting here that Cartiga fiercely disputes Hassett's version of events.
Right, we should be clear about that.
Yeah, they have stated publicly that he is simply a disgruntled former employee looking for a payout after a routine round of corporate layoffs. And they insist their underwriting process is completely independent and rigorously vets out fraudulent claims.
Fair enough. But even if we set aside the specific legal claims in that one whistleblower suit, the broader structural problem remains obvious.
Right.
It sounds like the tail is wagging the dog. The financial product is no longer serving the medical recovery. The medical procedures are being ordered to service the financial product.
Exactly. It is a complete inversion of the system's original intent.
Yeah.
The original concept was finance providing a bridge for an injured person in need. The current reality is finance demanding a steady supply of severe injuries to package into bonds.
And with the sheer volume of personal injury cases soaring, I mean, they are up 70% in state courts over the last decade.
That's wild.
The entities actually writing the checks for these massive settlements are noticing the shift. the insurance industry is not sitting quietly and absorbing the losses.
Oh, they definitely are. They're striking back with overwhelming legal force.
Right.
And this dynamic has created the defining clash of our modern legal system. It's big insurance versus the litigation funders.
Insurance giants like Geico, Uber, Allstate, and FedEx have launched over 60 civil racketeering, or ARCO, lawsuits just since 2023. And our ARCO suit is the same legal tool used to take down organized crime syndicates.
Right.
The insurers are alleging massive systemic fraud. They accuse networks of lawyers, medical clinics, and the funding companies of scheming together to gin up fake or wildly exaggerated claims.
And the insurers have gathered highly compelling statistical anomalies to back up their claims.
Yeah.
Because when you analyze the clustering of these lawsuits, certain patterns emerge that just defy standard probability.
Yeah, the most glaring data point in the entire investigation comes from Queens, New York. There is a single 3-unit apartment building.
Okay.
And over an 18-month window, 11 different people listing that exact same address all filed lawsuits claiming they suffered serious construction injuries.
I mean, statistically, the odds of 11 people living in 3 apartments all suffering catastrophic lawsuit-generating construction accidents within a year and a half are virtually non-existent.
It's insane.
It implies a highly coordinated effort at that specific location.
And it gets worse. Out of those 11 people, at least 7 of them underwent major surgeries, including spinal and neck fusions.
Wow. So the insurance companies point to data like that and argue it is proof of an industrial-scale scam.
Yeah.
They claim runners are knocking on doors in vulnerable neighborhoods, recruiting people, pushing them into unnecessary surgeries, securing the funding advances, and ultimately extorting the insurance companies for multi-million-dollar settlements.
But the funding industry is not backing down from these accusations either.
No.
Jack Kelly, who is the managing director of the American Legal Finance Association, argues that consumer legal funding is an absolute necessity. He maintains it is the only mechanism that levels the playing field against massive, infinitely resourced insurance companies.
And if we connect this to the bigger picture, his argument highlights the traditional strategy of the insurance industry. Well, insurance companies have teams of lawyers whose entire job is to delay payouts, drag out court proceedings, and economically starve victims out.
Right.
So Kelly argues that without legal funding, an injured person facing eviction would have no choice but to accept a predatory, low-ball settlement.
Yeah.
The funder provides the staying power to force a fair trial.
So both sides view the other as the predatory Goliath. The insurance companies say the funders are a cartel manufacturing fake injuries. And the funders say the insurance companies are ruthless corporations trying to choke off the only financial lifeline vulnerable victims have.
Exactly. And the actual human being at the center of the lawsuit is completely squeezed in the middle.
Yeah.
Whether their injury is a legitimate tragedy or an exaggerated claim, the plaintiff is often the one who walks away with pennies on the dollar, while the massive entities extract the real value.
There is a New York construction worker mentioned in the sources who perfectly illustrates this.
Oh yeah, this case is brutal.
He won a massive $3.75 million settlement. I mean, a life-changing amount of money.
Huge.
But after his lawyers took their customary 1/3 contingency fee and his funder recouped the cash advances, plus that staggering 40% compounding interest,
Right.
the worker walked away with just $500,000 out of the $3.75 million. The legal and financial machinery ate more than 85% of his settlement.
It's sad. The individual plaintiff has become almost incidental to the massive financial transaction taking place above their head.
Just when the battle lines seem perfectly clear, with insurers aggressively fighting Wall Street funders in court, we hit a massive structural contradiction. Here's where it gets really interesting.
Oh, this specific detail exposes the absolute weirdness of modern corporate conglomerates.
It is wild. So the very same insurance companies that are screaming about this system, filing ARCO lawsuits, and begging lawmakers to stop third-party litigation funding, are secretly investing in it. The investigation revealed that more than 30 casualty insurers have actually invested at least $136 million in these legal funding asset-backed securities since 2020.
It is the ultimate corporate irony.
It really is.
The claims defense division of the insurance company is paying out a potentially fraudulent settlement with its left hand, while the asset management division of that same insurance company is collecting a 7% yield on that exact same fraud with its right hand.
It even includes 16 members of the National Insurance Crime Bureau.
Oh, man.
That is the leading anti-fraud group in the country. They literally went to Congress last year to complain that legal funding was fueling scams and driving up costs.
Right?
And meanwhile, their own members are buying the securitized bonds that fund the industry.
It perfectly illustrates how blindly capital chases yield.
Yeah.
Because within these massive insurance conglomerates, the investment wing operates behind a firewall, completely siloed from the litigation wing.
So they aren't even talking to each other.
Exactly. The portfolio managers aren't looking at the moral hazard or the systemic impact on the court system. They just see a highly rated, uncorrelated asset offering a solid 7% return, and they buy in.
Unbelievable.
And when the Times confronted these companies, many suddenly backed away, claiming they no longer hold the investments and calling them misaligned with their core mission. But the fact that the money flowed there organically demonstrates the raw power of the financial incentives at play.
Are state lawmakers doing anything to regulate this pipeline, or is Wall Street just operating freely?
Well, regulation is moving slowly, but it is starting.
Yeah.
Over a dozen states have begun imposing basic restrictions, like capping the interest rates funders can charge or banning referral fees between lawyers and funding companies.
Okay.
But West Virginia is taking a much more aggressive approach by targeting the securitization itself.
And that legislative effort is being championed by a state senator named Mike Romano. And his background is key here. He used to be a fraud investigator for the Securities and Exchange Commission.
Right, the SEC.
Yeah, and when he looked at this industry, he didn't just see a local legal issue. He recognized the exact mechanics of Wall Street securitization.
Yeah.
He saw that the industry was constantly looking for new ways to multiply money.
Because he understood the fundamental economic principle at work.
Which is?
Once you introduce Wall Street securitization to any local market, you introduce an insatiable appetite for volume.
Right.
The financial product will inevitably demand more raw material.
Which brings us to why anyone listening to this should care.
Yeah.
Because even if you never step foot on a Manhattan construction site, and even if you never file a personal injury lawsuit in your entire life, this ecosystem affects you.
Absolutely.
The demand for higher settlements drives up insurance premiums across the board for everyone. It clogs the public court system with exaggerated claims that delay legitimate justice. And through the mechanics of institutional investing, this entire machine secretly lives inside the mutual funds sitting in your retirement portfolio.
Right.
We are all unwittingly participating in the personal injury economy.
The reach of the system is inescapable once it becomes securitized.
It has been a wild journey to trace. I mean, we started with a single individual dropping off a ladder.
Yeah.
The slow pace of the legal system led to him needing cash to survive. That need created an industry of high-interest, non-recourse advances. To sustain those advances, the funders turned to Wall Street, bundling the lawsuit debts into asset-backed securities. That Wall Street capital demanded high-volume, high-value returns, which created an economic incentive for forced spinal surgeries, which finally sparked a war with big insurance companies who, in the ultimate twist of corporate silos, are actually investing in the very securities they are fighting in court.
This raises an important question, and it is a philosophical one that goes far beyond the financial mechanics we've been dissecting today.
Okay.
If our justice system transforms from a place of truth-seeking into a speculative asset class designed specifically to generate 7% yields for global retirement portfolios, does the actual truth of an injury even matter anymore? If Wall Street algorithms require a constant, predictable supply of human tragedy just to meet their quarterly targets, are we inadvertently designing a society that incentivizes rather than prevents accidents?
Just something to think about the next time you see a guy on a ladder.